So today's agenda is really looking at the two numbers that drive profitability and cash flow within any law firm. So we're going to be having a bit of a deeper dive into what those two numbers are, looking at the average rate, efficiency factor, and profitability when we're talking about that number that impacts on profitability. Looking at some KPIs around average rate, also looking at the cash gap and its impact on cash flow, and looking at then the second number called lockup percentage. As Christina mentioned, we've at FWA Chartered Accountants, we've worked with lawyers all up and down the east coast of Australia for many, many years. And basically what I get to see when I'm working with those firms in terms of their strategies and their numbers to drive profitability and cash flow is a consistent and fundamental underlying lack of focus on the core things that really need to be implemented in their business to make a difference in generating more profitability from the work they're doing, but also turning that into cash. So what I'm going to be sharing with you today is an insight into what those last 15 years or so in working with law firms specifically has shown me to help you identify maybe some areas in your business where you've got an opportunity for growth. So let's get into it. There we go. Good. Here we go. So first thing we're going to look at today are those two, just a summary of what the two simple numbers are. And they're the average rate and the lockup percentage. So what the average rate is it focuses on this KPI, this guiding number. It allows you to focus on specific actions that drive improvements in your profitability. So I'm going to take you through how profitability is generated in a law firm. I'm also going to show you the key components that make up how you arrive at average rate, and we're going to be talking about some of those key actions and activities that you should be implementing in your business to enable you to improve that average rate. The second number is lockup percentage, and basically lockup percentage is how much of that revenue that you've done, how much of that work that you've done in your business hasn't yet turned into cash. What's sitting there to be billed, or it has been billed, but it's not yet in your bank account, and how does that relate to the amount of revenue you make in a year? And then extending that and looking at, well, what are the actions and activities that you need to be doing within your firm to be able to drive that lockup percentage down so that it improves your cash flow. So by combining strategies that constantly focus on increasing your average rate and reducing your lockup percentage has the double whammy effect of increasing profitability and then increasing cash flow. So the greater your profitability, the lower your lockup percentage, the more money you have in the bank. And quite frankly, there can never be enough of that. Okay, so let's look at average rate to start with. So what I'm going to do is I'm going to take you through a bit of background, bit of conversation. Then I'm going to pull up some calculators and I'm going to step you through the mechanics of what you need to be focusing on and how focusing on the right things has a significant impact on the numbers. And I'll make no bones about it. I'm a chartered accountant. The numbers tell me the story, and that's what I see. And what I get to see in firms is when they focus on the right things, it has a profound impact on their profitability and cash flow. So the first thing that we'll do here before we get into the looking at what an average rate is and how it's calculated, might just launch a little poll here just to get a bit of a feel for where everybody sits in relation to this. So Christina, over to you.
Yeah, thanks, Matt. So before launching the polls today, I just want to go over a couple of points depending on how you're viewing this webinar today. So if you've joined us using the Microsoft Teams application, a notification will just pop up in the middle of your screen, which you can respond to. Or if you've been watching through a web browser, the poll will be available in the meeting chat. So on the meeting controls in the center at the bottom, you'll see a few icons. There's a speech bubble icon, and the third button from the right is where you click to open up that meeting chat, where you're able to respond from there. So let's go into the poll. Okay, so the first poll, we actively manage the ratio of our labour costs to our revenue.
Okay, so Christina, I'm sorry, but I can't see the poll coming up on my screen. So would you mind just running through those answers?
Okay, not a problem. Thanks for that, Matt.
Again, sorry for the glitch, guys. Just first time using Teams for webinars.
All right. So we actively manage the ratio of our labour costs to revenue. So for some of you, is it never, rarely, sometimes, often, or always?
Okay, so we everyone answered. Right, what are the results?
Okay, so what we've got there is we've got 24% said never, 28% said rarely, 36% said sometimes, 12% said often, and always is nil.
Okay, so that's a pretty normal response. So thanks for that, everybody. Simply by focusing on this average rate and the components of it, if you can really drill in and have a look at the underlying activities that drive these numbers, it produces a greater possibility of revenue for you. At the end of the day, you have to bill it and collect it. So let's get into it. So what is the average rate? So average rate is the amount of revenue that you earn for every direct hour of direct labour costs that you pay. Okay, so it's calculated by dividing the revenue by direct labour hours paid. So let's talk a little bit more about those two components. So your revenue is what you bill. Okay, whilst you've got work that you're doing that's sitting in your work in progress, it's not revenue necessarily at that time. It will be at a point in time when you bill it. But to generate that revenue, you need to employ people. And those hours that you employ people, you have to pay them whether they're there or not, whether they're on holidays, whether they're standing around the water cooler talking, whether they're generating and booking time into WIP or not. And these direct labour hours in your business, they include all fee earners, or principals, or solicitors, or paralegals, legal secretaries, conveyancers. These are the people that are directly employed to generate that revenue. So in law firms, the input costs, the main input costs for generating our revenue is our direct labour cost. It's the cost of that labour. So we've got to generate sufficient levels of revenue out of every hour that's possible so that we get the right margins and profitability. So the higher that average rate, it indicates better profit performance. So if you're generating more revenue per hour that you pay, you should generally generate more revenue and profit. Now, there's quite a disconnect that I find in working with law firms, and particularly with solicitors, around what they perceive as what they make per hour for the firm and what they actually really do make per hour. And I'll highlight that for you shortly, because what's really important in working with your fee earners, particularly as solicitors, where there's usually a great base of capacity for growth, is making sure they're educated and they understand the mechanics of how revenue is actually calculated and the impact that they have, and that it's not as much as what they think it is that they make per hour for the business. So a little bit of understanding around what makes profitability and what's profit. So the first thing is, let's just look at a simple P&L and let me show you those key components of what we've got to focus on to drive profitability in the firm. So let's just think about this as being your firm. That rectangle there to start with represents all the revenue that the firm generates. And out of that revenue, you've got to pay all of your expenses before you make a profit. So what comes out of that revenue to start with is your direct labour costs. So from an accounting point of view, from a management reporting point of view, the first thing that you should be doing is separating out your direct labour cost. This is so that you've got a really clear picture of how much it's costing us to employ people to generate that revenue. And that labour cost doesn't then include people like, say, receptionist or a practice manager or IT and so on. What it does, it just focuses purely on that input cost. So if you think of any purchase that you make, if it's a pair of shoes, those shoes have got a whole range of different input costs that go into it. Those input costs are laces or buckles and leather and stitching and labour and a whole lot of different things. So all these different costs combine, but not necessarily the costs of the head office. It's those specific direct costs that create the product directly. In your firm, that's labour. Yeah, you've got a lot of other expenses that you've got to pay, but the thing that the specific input cost is direct labour. And that's why we've got to measure the cost of that against the revenue. So your revenue minus your direct labour cost is your gross profit. And that is a critical number. Most firms do not measure gross profit. Gross profit is critical because what gross profit does is that determines the mechanics of, well, it gets you focused on the mechanics of how you generate your revenue, how you bill, how you create that revenue. Compare it to the amount that it costs you, because that gross profit then needs to be enough to cover your overheads, like your phones and your practicing certificates and your computers and your rent and all of those things, to produce your net profit before principal salaries. And then out of that net profit, that's when you got to pay some tax, your loan repayments, drawings, etc. All those things that don't necessarily impact on your profit, but they do impact on your cash flow. So the key to a better, in a law firm, the key to a better net profit is a better gross profit. Your overheads, you can generally trim a little bit, get some economies out of them, but usually you can't trim them too much. Most firms have got pretty clean overhead expenses in their P&Ls. Sometimes it's about the indirect or the administration labour costs could probably be tightened a little bit. Often that can be improved with better use of technology, systems, processes, and so on. But where the real gap is in that gross profit. Your direct labour cost is actually relatively fixed. It's there. You choose to employ these people. So your variable is how much revenue do we generate out of that. So what your average rate does, it looks at that revenue. It then looks at how much direct labour cost you're paying. And then if you know that ratio for your gross profit, you can then start tracking improvements in your profitability. So there are fundamentally 4 numbers that you need to really be looking at. And the headlining number here is average rate, which is the second one there. And average rate, as I said, it's just your revenue divided by the paid hours. So that determines, is your pricing right and your billing strategies right to produce the right amount for the fee so that the firm generates the right amount of revenue to produce the right amount of profit. And how you can improve your average rate. First and foremost is focusing on your file velocity days, which is basically the average number of days between when you sign a cost agreement and the file's closed. And when I say the file's closed, I mean it's delivered, the matter's delivered and it's finished and it's billed. So the shorter that period of time, the general improvement in your average rate, simply because it allows more work to be done over a shorter period of time. It's not about racking up more WIP and then billing it. It's about getting things done as efficiently as possible. The two main drivers of profitability in a firm are efficiency and customer service, client service. So happy clients where you got the results or you've done the work and as efficiently and as quickly and as in an informed and inclusive way as possible keeps them happy. They pay, and the more efficiently you do that in terms of systems, processes, the least amount of time, the more profit you end up making. I very rarely come across any firms that say, hey, we're not busy. Hey, we don't have enough work. Occasionally there is, but in the main, there is heaps of work to do in a law firm. So focus on your file velocity. Productivity is the next one. So productivity is those number of hours that are charged into WIP as compared to the available hours. So if your available hours were say 8 and you expect and someone only charges 4 hours in there, then they have a productivity number of 50%. So only 50% of the hours that they're there at work, being available hours, is their productivity. So a key strategy and key focus you've got to have is looking at optimizing that utilization and so that you leverage that fee earner employee cost. So again, and I'll show you this in a moment on the screen, but if you're looking at paid hours, all the hours that are paid, and you're looking at how many of those hours are actually going into WIP and how many of those hours that are in WIP are actually getting billed, very quickly you see a big disconnect between the number of hours that are billed and the number of hours that are expected to be billed. And I'll show you that very, very shortly in terms of the different average rates. And then you have your write-on, preferably, but usually it's a write-off, which is the percentage of WIP that isn't billed. It's the percentage that's written off. Whilst you've got amounts of time being entered into work in progress, if that doesn't get billed, it further impacts on your profitability. And what that does, it focusing on your write-off percentage and your write-off dollars identifies sources of inefficiency in your business, which might mean people spend too much time on that work, or you've got inefficiencies in your billing process, which enable people's perception of value to dictate the amount that gets billed, and so they naturally just write off some of their time, even though they probably haven't put it all into WIP anyway. So just another little quick poll here, just to get a bit of a measure of average rate. If Christina, you could launch that poll and then
absolutely
run through the results.
Yep, for sure. So this next poll is our best estimate is that our efficiency factor is 65%.
Oh, sorry, that's not the right one.
Oh, I beg your pardon. Productivity and write-offs, I beg your pardon.
Yeah.
Let's try that again. Okay, we monitor productivity and write-offs, and that's either never, rarely, sometimes, often, or always. Just a few moments on that, and then we'll look at the results. Okay, results are in. 12% Matt said rarely, 47% said sometimes, often 20%, and always 15%.
Excellent. So we've got some always. Well done, peoples. So again, very normal thing. It's we very much pay attention to the work that's being done, but what doesn't happen in firms is they don't pay attention to those key drivers that really make the difference and what those activities are that need to occur in a firm to improve those numbers. So the next concept that I want to talk to you about is the efficiency factor. And when firms actually get a bit of an understanding of this, and then they even go to the extent of looking at it via, say, departments in their firm, and a department doesn't mean an area of law to me. A department is a group of people and the relationship between the revenue they generate and their labour cost. Which often is within areas of law, but sometimes you've got people who cross over into different areas of law that are from within a department. But what the efficiency factor does, so this is a concept that's critical to understanding when we're looking at what is possible in a firm. So the efficiency factor measures how well a legal firm uses its fee earner labour costs to produce that revenue and gross profit. So if we think back a step to average rate, where what we're focusing on is the dollar value of revenue that you generate per hour for what you're paid, that's the actual number. So that gives you an average rate. What we need to know is, well, what's possible? What do we really expect to be making so that we can see that gap? So how we work out efficiency factor is we look at calculating it by dividing the revenue by the capacity. Okay, so how much revenue do we actually bill against how much we could have billed, the maximum amount if everyone hit their numbers. Okay, so capacity is the sum of each of the individual capacities of a fee earner. Okay, that individual capacity is calculated by multiplying their standard available hours, which is, I use 1,672 hours, by their target productivity percentage, which is their number of hours they're expected to bill into WIP divided by the standard hours in a day, multiplied by their charge rate. And that's for all fee earners, including principals. So what that gives us is that capacity revenue number. If everyone hit their numbers and did everything we'd expect of them, then this is the number that's possible. Now, very rarely does that ever get hit, or often very rarely does it get close to being hit. But once we understand that number and we can compare it to what's actually happening, it then drives us to enable to start making some decisions and start benchmarking against those how we're performing. And I'm not talking about benchmarking necessarily against other firms. I'm talking about benchmarking against our own performance, focusing on what needs to happen within different departments or with different people and so on. So what it does is efficiency factor, by using capacity, allows us to set an upper limit of our average rate. So it's basically saying this is the capacity, it's the maximum amount of revenue that we could generate for these number of available hours. So what's that capacity average rate? And so then it allows us to identify the gap between what our actual average rate is and our capacity, and then develop strategies to focus on what we need to do to improve our file velocity, improve our productivity, improve our write-offs that are happening. What are the key systems that we need to put in place to do so? So, Christina, if we can just run that efficiency factor poll, and then I'm going to jump into some numbers.
Absolutely. So I'll launch that poll again. Our best estimate is that our efficiency factor is either 65%, 65 to 75%, 75 to 85, 85%, or no idea.
So remembering it's the ratio of what your capacity is, your actual revenue is compared to your capacity revenue.
Okay, we've got the numbers in, Matt. So we've got, they're just jiggling a bit there. So at 65%, we've got about 18%. 65 to 75%, we've got 18%. 75 to 85, around 11%.
Yep.
85%, 0, and no idea, 47.
Yeah, and absolutely expected. Thanks for that. So again, not an unusual response. This concept, this focus, just is never taught to anybody in law firms. And look, it's not just about law firms, it's professional services firms generally. This concept of really understanding what the amounts of revenue are that we need to generate based on our labour cost to produce the profitability that we expect from the work that we do. So let's hop into some numbers here now. Just bear with me while I pull up a calculator here. So, okay, so what I'm going to do is I'm just going to work through this as an example so that you've got a clear understanding of this concept of what capacity is and what average rate is and what gross profit is. And I'm just going to be using an example here of a singular solicitor. So to start with, let's get an understanding of that concept of paid hours and available hours here on the right of the screen. So the first thing is, if we just start with a standard work week of 38 hours in a week, and if we look at how many hours there are paid in a year. So if there's 52 weeks in a year, then it's 1,976 paid hours. So for a full-time equivalent person, so in this case solicitor, you pay them 1,976 hours in a year, whether they're there at work or not. They get 4 weeks of annual leave. They get 2 weeks of public holidays, and they get 2 weeks of personal leave. Sorry if we've got some people here from Melbourne. Your public holidays, I think, are about 9 weeks a year, because I think you get one nearly every sporting event. So if we break that down, you've got 304 days that they're not expected to even be at work that you're paying for them. So that gives you 44 available hours, or available days, or 1,672 available hours. So to start with, you're already behind the 8 ball if you're thinking about how much revenue you need to generate from those hours that you're paying, because there's a percentage of those hours that you're paying that are not even going to be there. Okay, so let's look at how we calculate average rate. Let's look at, let's say an example here of a solicitor and what might be expected in terms of what their capacity is and what they might actually achieve. So let's put some numbers in. So let's say you've got an expectation of 5.5 hours. Now, just on that point, 5.5 hours should be an extremely normal number for any fee earner, a solicitor, to be able to achieve. The issue is that they're not busy and they're not doing 5.5 hours a day. The thing is that they're not putting that time into WIP. And I'll come back to that shortly. And we really need to, as part of what you do, is change people's perception of WIP so that it's not a point in time where they're deciding to bill or not to bill. It is a methodology for looking at how much time so we can build empirical data and determine what we may build. Completely separate webinar on that entire topic. So let's look at this. So we've got 5.5 hours a day. So out of that 1,672 hours, there's only 1,210 hours there that would be expected to be charged into WIP. If people did 5.5 hours for every day they're there. If their charge rate was 420, then the capacity, their target revenue, the max revenue that they'd be able to achieve if they hit 5.5 hours every day and build it all, would be $508,200. So that's your capacity. That's your starting point. So we can see in this little KPI summary down here, our charge rate per billable hour at capacity is $420 per hour. That's not your average rate. That's not the rate you're making per hour. That's just the hour, the rate that you expect people to make for every hour they add into WIP and build. But in this case, let's see what the reality is. And in this case, the time that was actually entered on average over that year is 4.6 hours. So that produces an amount of dollars into WIP of $425,000. So the starting point there is we've already got about $80,000 short of time entry going into WIP. And if we've already got that shortfall, it makes it very difficult for us to hit our budgets. So we've already got this gap that's starting to increase, the difference being of our capacity and our actual. But then to make it worse, 10% of that is written off, so that all that gets billed is $382,000. So now what's that? We're down to $126,000 roughly being the shortfall of actual revenue billed and what was expected to be billed. And for this employee, we got to pay them $125,000. So our gross profit then is $257,000. So if we flow this through around these different average rates and looking at the different rates and what you need to be focusing on, most people, if they're going to focus on a rate, they focus on the first one. They just think. Solicitors think they make $420 an hour, and they don't. To start with, you've got to go and look at, well, all the hours that you did put into WIP, what was the average rate that you actually generated in revenue per billable hour that you added into WIP, which isn't the capacity, it's based on what's actually billed. So 382. So that gives a charge rate per per billable hour of 378. But the difference here, though, is that that's not the average rate that you actually make, because you pay this person $125,000, and over here they've got 1,976 hours that you're physically paying them for. So their average rate per hour that they're paid is only 194. And this is usually a big sort of, you can sort of hit, when I run through this with lawyers in firms, you can sort of, and particularly as groups, you hear the penny drop, and they go, oh, geez, that's a bit on the low side. That's a bit different to what my expectation was. So there's a big gap. There's this big discrepancy. Key is to educate, make sure people understand how these numbers work and what the impact is. What that then drives is the efficiency factor. So in this case, this 75% is the difference between, is 382,000 as a percentage of 508,000. So this person is only running at 75% of their revenue capacity. So there's a 25% gap there, which is effectively $126,000 for that one person in terms of spare capacity to generate revenue. Doesn't mean they can work any harder, but what it means is the systems that we've got in the business need to align to getting that time into WIP and billing it. And that's how we drive it up. Not asking people to work harder. We've just got to get some education, training, structure and process in place to enable them to improve their productivity percentage. And then we've got to look at billing processes to drive improvement in billing. So if we then flow that through and really look at how these numbers compare, you've got a $63 of a labour cost there for every hour that's paid. A bit of rounding in here, but your gross profit paid per hour then is 130, just your average rate minus your labour cost, and that gives you a gross profit per hour. So this average rate figure here is where we really need to be focusing on. We need to be looking at what are the underlying strategies that really impact that. So if you can remember, I said before, 3 key areas: focusing on your file velocity, getting work done faster, improving your productivity, which means more billable hours going into WIP per fee earner per day, which doesn't mean doing more work. It's just entering it. It's just recording it, better systems and processes, and then billing more of what's in WIP. So let's have a look at what some differences it might make just by tinkering around with those key drivers. So one way of generating more revenue is to increase your prices, for sure. But, you know, that's a lazy way of doing it. But what I also see in most firms is charge rates for lawyers at all levels are way too low. Let me explain that to you. Why I say that. The perception of the price resistance in law firms does not sit with the clients. It sits with the lawyers and their perception of value. Lawyers deal in the area of conflict. They're dealing with emotional issues with clients, and that those areas of conflict are one of two things. It's either preventing conflict occurring, so in the future, or resolving conflict that already exists. Most clients come to law firms because of referrals, and most clients either from existing clients or family and friends or from professional networks. Those clients generally have made their mind up when they come there. So I'm not talking necessarily about pure conveyancing that's built on fixed fees. I'm talking about generally the real rate per hour stuff. So most people go there because of that. So they've generally made their mind up that they're going to buy from you beforehand, because one, they're coming to talk about an emotional issue, a stressful issue, and they're not going to go price shopping on that. And so they make their mind up that they're generally going to be using you before they even come there. And secondly, they're doing that on the basis they don't really know what you're going to do. You've got to solve something for them, but they're also doing on the basis that they think you're expensive. So all I can say to you is stop disappointing them and back yourselves and bill them what you're supposed to be billing. So put your charge rates up a bit. So let's I digress a little bit, but let's just look at how these numbers work. So even if we only put that rate up by $20 an hour, that produces an extra $24,200 of potential time into WIP. But what we do is we increase the productivity, but they don't even get to their 5.5 hours. They only get to 5. But just by doing that, it increases the actual amount that's gone into WIP by $58,000. So had an extra capacity increase of 24, but we've increased that simply by we've increased our average rate. We can see there already, because our increase in what's gone into WIP is more than what our capacity increase is. And that's achieved by just recording another 24 minutes, 4 extra units a day. They're doing that. And then what we can do is we can reduce our write-off, say down to 7%, which then improves the revenue growth by $67,000 all up, and then drives an improvement in our gross profit. So let's see what those numbers then look like, and those differences. So 420 goes to 440 on our actuals. Our charge rate per billable hour gets closer, therefore, to our actual expected charge rate, but our average rate has gone up from $194 to $228 without an increase in our labour cost. And it improves our efficiency factor by 10 percentage points, brings it up to 85%. Now that's just with a $20 increase, with 24 minutes a day, and which is still half an hour short of expected budget, and then just a slight improvement in writing, so billing a little bit better. Significant improvements that makes in that average rate. So you can see where if we focus on this average rate, we're going to continue to get, and we can apply this across all fee earners in the business, the multiplying effect on profitability is significant. Okay, so let's just jump back into the presentation now and have a look at those key components of your revenue plan. So here's a few practical ideas. First of all, the success of your revenue depends on how engaged your fee earners are around understanding what's expected from them from a financial perspective. So look, I make no bones about it. I said it before, I'm a chartered accountant. The financial health of your business is in the hands of your fee earners and in the people that bill. So you need to put the effort in and the focus on managing them around around what's expected. The starting point is to make sure they understand what's expected. Make sure is that they acknowledge that they can achieve what's expected. Most fee earners haven't got a clue. The budgetary processes, the expectations conversations at the beginning of each year, at the beginning of each, end of each quarter, so on, they rarely happen in firms. Everything is just left up to the fee earner's own thinking to determine if they're going okay or not. So once they know what's expected, my experience is that once fee earners are engaged and understand that, and then they receive information on how they're performing, they actually self-regulate. So you need to be providing your fee earners with weekly and monthly reporting that shows them how they're going actual versus budget. This is what was expected. We met about that. We talked about it. This is how you've actually gone. Now, a little trap here for players. Most practice management systems, or I shouldn't say most practice management systems, all practice management systems use a static budget system for when you allocate budgets to your employees. So that means, expected to do $480,000 worth of billing a year, so it's 12 months of $40,000. If someone's away for 4 weeks, their budget should actually be zero for that month of time entered and billed, but they'll still have a $40,000 billing budget that will be shown in the system. So you've got to be very mindful about the information that you provide, and also in doing so, make sure that that's linked back to their actual available hours, the days that they're actually there. How many hours did they actually put into WIP based on the days that they're actually there? What did they actually bill for that period of time? So on a future webinar down the track, I'll show you a system that we built called My Numbers that actually uses labour data being of actual available hours and actual paid hours for employees, and connects that data to practice management system software that allows that reporting to be fed back to employees. So that's really important. It allows them to self-regulate. Focus on your workflow. The better you focus on your workflow, the better that you can better chance you've got of generating the revenue. So weekly workflow planning and monitoring is essential, and it's making sure that the discretion isn't just left up to the employees to decide what they're going to be working on. Yeah, there's a really good element of that in there, but really making sure that, you know, there's appropriate structure in place for ensuring that matters are progressing, that their billing, that billing targets will be able to be met because the matters progressed in the right methodology. And lastly, create a WIP policy. WIP is not about billing. WIP is your measure of the time spent on a job, and it is then the guide for determining whether or not you bill a client. Too many firms have their fee earners making the decision whether they enter time or not because they decide whether they can't bill it. So first thing is get rid of zero charge rates and the ability for your employees to change their charge rates or to enter non-chargeable time. Everything that is worked on the client file should be entered in WIP. It's a different story about billing it. That's the magical. That's the secret sauce to improving your WIP. But the key is to be really clear on a policy. And the key is not to say what does go into WIP. It's to say what doesn't go into WIP. My view is that there's only 3 items that should never go into WIP on a matter. 1 is cost agreement. 2 is raising a fee. 3 is answering a fee inquiry. Everything else should go into WIP. It doesn't mean it gets billed. So we're focusing on that first component here of getting time into improving productivity. So if we get more time into WIP, then what we're able to do is we're able to bill it. We might blow our write-offs out of the water, but if it's in WIP, at least we got a chance. So there's just 4 simple activities that you should be focusing on in your business that allow you to drive up that average rate. Billing is also a big one, but I'm going to cover that off here. So now let's hop into the second driver, the second number, which is your lockup percentage. And it's really important to understand what I call the cash gap and the impact that it has on cash flow in your business. So the cash gap is the period of time between when a cost agreement signed and when you get the cash for it. Okay, makes simple sense. So there's this time where we're doing all of this work and we've finished doing the work, but we haven't yet got paid for it. Okay, we're incurring a whole lot of other expenses as we're going along, but we're not getting paid. So the key to improving cash flow, apart from profitability, is reducing this cash gap. It's reducing the time between saying, okay, let's start the work, let's get it done, let's get it billed, let's get it in the bank. How do we reduce that time? So cash flow is the lifeblood of every business. If you don't have cash, you can't operate. So yeah, drive profitability up by all means, but unless you manage your cash flow cycles to get that cash in so that you bill it and then it lands in your bank account, you don't have the cash after tax cash profits to, pay yourselves as principals, any drawings, or to make loan repayments, or to invest back in the business, or create a buffer of cash in there for a rainy day. So law firms have got to aim to minimise this cash gap. And the way to do it is by focusing on the activities that drive your lockup percentage. So the start and the end, the 2 points of the cash gap: cost agreement signed and cash being received. So within this cash gap, you've got 2 components or 2 numbers that you've got to look at. So let's say at that point there in that cash cycle, you finish the work. And I'm assuming here that there's just 1 bill done. Regular billing should happen more often on a file, but just for simplicity here, that we've got instructions, got our cost agreement signed. We do the work and we finish it and we bill it, and then we wait for the money to come into the bank. So the beginning part before we finish that work is our work in progress, which is a critical number to manage, and it really doesn't get paid enough attention by law firms. It is the key dollar amount and the key number that drives profitability improvement, revenue growth, and cash flow improvement. But people focus on everything that happens after the WIP. It's what goes into debtors. It's what we bill. It's what we collect, where The activities that drive both of those initially is your work in progress. It's timesheet entry, it's productivity. So if we look at those and say, okay, what is that cash gap in this business? Let's say that matter took 90 days, 3 months to get finished, whatever it was. Let's say it's a simple lease where you've got a very difficult tenant, and they're just not responding and so on. So you've got 90 days worth of work there. In that 90 days, you've paid for wages, you've paid for phone, you've paid for rent, you've paid all these different things, but you haven't got any money in the bank. You haven't even billed it. So you finish it and you bill it, and then you wait another 60 days until that cash comes in. So that's a total of 150 days that you've got to wait for that cash. And that's 150 days in a whole year. And think about all the costs and outflows that you've had to pay for and fund in that time. So it makes sense that if we can really focus on shortening that cash gap to the lowest possible period of time, we've got to improve profitability, cash flow. And if we can combine that with improved profitability by focusing on generating the revenue we should be generating from the work that we've done, then we're going to get a double whammy of that. Okay, so let's look at the definition and calculation of lockup. So just our final little poll for the day. If Christina, we can launch that problem. And
yes.
Keep moving. I've only got sort of 10 minutes to go.
Absolutely. So the next one I'll launch, we have a structured process for billing WIP and collecting debtors. Choices there: never, rarely, sometimes, often, always. Results are coming in, Matt.
Excellent.
So rarely is 25%, often 25%, and always 50%.
Excellent. So again, just going back to my little diagram there, there is always a big push, a bigger focus. Sorry, not so much big push. There's always a bigger focus on billing and collecting. And it's really how we manage that WIP. So it's often what happens at the time when we finish the work. If we've got a bigger amount of a pie to bill, generally we've got a greater chance of improving our revenue and the greater chance of focusing on data. So if we can get systems in place that really drive these outcomes, it's going to produce more cash flow for the business. So lockup percentage, it's the percentage of your annual revenue that you haven't yet received in cash. So if you like, it's the total of your WIP and your debtors, okay? So it's those two amounts of in a dollar form as a percentage of your revenue that you haven't yet collected. So it's your total of your debtors and your WIP divided by annual revenue. The lower that lockup percentage, the faster the cash flow. And the improvement in your liquidity, provided you've got the right profitability ratios being occurred. So the two functions that directly affect lockup percentage is your billing and collection policies. And they're influenced by the frequency and timing of billing, what your trust account deposit policy is, what it says in your cost agreements, and having dedicated resources for billing and collection. And when I say dedicated resources for billing and collection, they should not be your fee earners. They have an emotional connection. Okay. Okay, so when you're looking at your cash flow systems, what you need to ensure you do is you design them for the business, not for the client. Don't worry about the client. You're operating a business. You need the cash in the bank. They sign up on your cost agreement. They sign actually up on the rules of how you're going to bill them. So bill them and collect it. If it means you've got to put their matter on hold, put it on hold. So ignore your industry norms, whatever's relevant. You know, if a firm says our terms are 14 days. To bill. No, I've got clients where their terms are pay on invoice if we don't have money in trust. You know, you can choose whatever you like. So to reduce your cash gap, work out what those terms are. And what you got to enforce is trust account deposits as much as possible. It's a key to driving down your lockup percentage. If you say it to clients, that's what they've got to do. You know, they've got to make a choice whether they want to do it or not. You often can deal with, you know, most debtor collection issues right at the front end by either having money in trust or not doing the work. Make sure payments happen at stages. So make sure that if that's the terms, that it gets billed and there's payments that are made, and have a structured collection process. So the challenge around this is to not to think about what suits clients. It doesn't matter. It's what suits the firm. How much cash do we need to survive? Remember, going back to this, you've got all of those outflows and costs. You don't get credit terms on your rent, on leasing costs, on wages. They all get paid during the month. I'll just get back again. Okay, so let's just take these calculations through to another level here and have a look at what that means for lockup. So if we look at this same firm or a firm, I'm going to bring all this together in a moment, but let's say that the firm has got work in progress of $350,000, which is 71 days. And that's just the revenue. It's a number that I've included that I'll come to shortly. But they've got 71 days. It's 71 days of work, or over 2 months worth of work that they've done that haven't yet been billed out of that, and their revenue they've billed is only 1.8. So that's extra revenue that's just sitting there. And their debtors in this case are $250,000. So their debtors are sitting out there for 50 days. So if we look at what the lockup percentage is, they've got revenue lockup with plus debtors of $600,000 divided by their revenue for the year. That's 33%. So 33%, there's 33% of cash, if you like, that's sitting there able to be accessed if we change our decisions and implement things a little bit differently. So let's see what sort of cash could be generated if we were to implement strategies that drive improvements in these two numbers. So first of all, let's say we implemented a monthly billing policy where whatever matter isn't a deferred matter and we reduce our deferred matters, or isn't a state obeyed or something like that. But majority of those matters, that everything else is monthly. Your cost agreements will say you bill on a regular monthly interval or regular interval. So you have the ability to do that. You just choose not to. So that's how we could get those debtors days down to 45, which is 1.5 months. So the impact that has is it reduces that $350,000 down to $223,000. But what it does, it produces an additional revenue that gets billed of 126 grand. So you get a revenue growth there. What then happens is we've got that extra revenue that's billed that goes into WIP. And then what we do is we focus on getting our WIP down to, say, 30 days by improving our trust account policy, by more amounts being billed, by having a strong debtors collection follow-up and process. And what that has the impact of is of improving your cash flow, because it means you've got extra cash that gets collected by a reduction in that debtors. You've got extra revenue and then the reduction. So you got $217,000 as a one-off, effectively, by doing the same work, just billing it earlier and collecting it faster. So there's no business that I don't know of that wouldn't like to see that. So the key is to then think of the strategies. What are those strategies that we need to now really be focusing on to achieve this? So the components of a strong cash flow plan. First of all, engage your clients, provide fee estimates or fixed cost agreements. And in those agreements, prescribe your interim billing amounts or dates and when they're going to be issued. We bill on a monthly basis. Then what you need to do is you need to make sure the client clearly understand that. So having fixed billing and payment terms, cover that off at the front in a simple covering letter to your clients that attaches your costs agreement. So that's the thing they read, because we all know clients don't read their costs agreements, but you need to make sure they understand the terms of how they're working with you. You need to then make sure that you've got an administration function for raising and collecting your fees. The reason for this is that there's no emotional connection then between drafting of the fees and collecting the money. So It doesn't mean that administration sign off on fees. There still should be a review process by the fee earner. However, you build structure into your business so that the fees are actually prepared at the date when their client is expecting them in accordance with the cost agreement, which then gets it out of WIP and into debtors faster, which gives you a greater chance of billing it. And I can tell you, the more regularly you bill clients on their matters, the quicker they pay. It's what they prefer. The only reason it doesn't happen in your firm is because you don't do it. Clients have agreed to a process. And then lastly, really focusing on as much as you can, cash into your trust account daily. Trust account transfers daily. Money in trust is a great way of managing your cash flow cycle. And especially if you can't, you've got to really make sure you've got strong, focused debtors collections after that. So let's just bring all of that together as we get towards the end of our webinar here. And what I've done is I've just taken this basic information that I've put in here and put it together in a bit more of a larger format for a firm. So looking at this particular solicitor, looking at these lockup calculations, and then saying, right, let's have a look at this from an entire firm-wide perspective. Now, if we break this down, and going back to these different numbers here and looking at average rate, for example, here we've got a firm that's got two principals, $500 an hour. They're expected to do 4.5 hours a day, but they do 5.1 because they're picking up the slack. I see that so often in firms. There's two solicitors that are employed, $4.20 an hour, only doing their 6. So these are the numbers that I had. So if you look at these average rates, 253, 194. But then there's also three legal support people that are in there. And their expectations only to do 2 hours a day, but they spend nearly all of their time doing work on a client matter. So these hours here drive productivity. Doesn't mean it's going to be billed, but it drives productivity. It's doing work. Charge rate's 160, but they do less than an hour a day. Then what they do is write it off. So the money that we're actually making on them is $8 an hour. And I see this all the time, firms, that there's next to no money being made on support, but it's a real labour cost that 1,976 hours a year that is being paid. We see shortfalls in solicitors, we see shortfall in labour cost, in legal support. Therefore, it drives that average rate down. So in this case, when we combine all those numbers on that $1.18 million worth of revenue, this firm has an average rate of only $131. And believe me when I say that is usually a higher rate than what I see in firms where they're not focusing on the right strategies in their firms. Often I see that number falling below $100 an hour, which means you can find it very difficult to generate any profit. So let's just follow this through and give some more context here before I finish this off around how all this comes together. So again, instead of looking at this on an individual basis, if you're looking at your planning for a year and you say, okay, what are we going to do to drive improvements in our profitability? So assuming all things being equal, our overheads don't change, our labour cost doesn't change, we've got to focus on how we're going to generate more revenue out of our labour cost so that we drive up our average rate to produce more gross profit that can then land into debtors that we can then bill. We want to bill that in a shorter and collect it in the shortest possible time. So when we're looking at our actual productivity, let's say we've got 42% there, but we've just got to get our support people up a bit, and we've got to get our solicitors billing a bit more. So let's say we can just focus on what are our strategies around re-educating them in terms of their entries into WIP, better systems and processes, better accountability, better engagement, making the invisible visible with reporting so that there's self-regulation, and we get 8 percentage point increase. So what that produces at that point is almost an extra 1,000 hours that are billable hours into WIP. So that small increase just produces that extra nearly 1,000 hours. And let's put our prices up a little bit across the board. So we've just got $450 that we're going to increase our charge rate to. So what that then has the opportunity, what that then produces, it produces time added into WIP of 2.6 million versus 2.06 million. And it's bordering on an extra $600,000 worth of increase in WIP. Well, let's pull this back down a little more. Let's make this 47%. 2.475. We're 400,000. Let's just make this 440. All right, there we go. So these are small changes, small improvements in these key drivers that ultimately drive, $350,000 increase in our level of WIP. But what we're also going to do is going to build more. We're going to have some more courage, and we're going to build more of our time that's in it. We're going to engage clients better. We're going to stick to us. We're going to re-engage them as matters exceed, what our original budgets were, and so on. So we're going to improve all of those areas, but we're not going to massively. We're only going to bring that down to 9%. But what that does, it results in nearly a $400,000 increase in revenue from the same costs and from the same work. I'm not talking about going and finding more clients. I'm talking about here making the money from the work that you're currently doing, what's being left on the table. And to do that, it only requires an extra 25 minutes on average per day across the board being added into WIP per fee earner. Four units. It's next to nothing. They're already doing that. We just need to get it in the bank. Sorry, get it into the bills. So then what we're going to do is we're going to take these lockups, as we're going to see what impact this has on cash. We're going to revert back to these lockup percentages that we're striving for. So we're going to implement better billing processes and get our WIP down. So we're going to get this down to 45 days from 71. And then we're going to be focusing on trust account, better billing, more regular billing, better data collection, and get that down to 30 days. What that has from our starting point here at the beginning of the year of $600,000 worth of WIP and debtors, by driving those strategies, increasing our profitability, improving our billing and collection processes, has a potential for putting $500,000 worth of real cash back in the bank. And as I said, I don't know any firm that wouldn't want to be able to do that. But mind you, this is only happening from some very slight changes in our policies. If we didn't improve them at all and we just kept our billing and our collections at the same, we're still going to get some extra cash that's going in there. Almost the same as what's being billed out. That'll be a little bit of rounding. It should be the same number, but we really should be able to get, with some focus strategies, improvements in there. So that brings me now to the end of our webinar. And sorry, I've run a little bit over time, but as always with our webinars, I like to make an offer that for the first 5 people who email me today at matt@fwoca.com.au, I'll organise a free 45-minute online meeting via Teams. And what we'll do is we'll review your numbers for the last 12 months to determine your average rate and lockup percentage and have some conversations around that. We'll just need a little bit of data from you, but nothing much more than what did you bill last year, what was your WIP balance, what was your debtor balance, and how many hours did you pay people. Once we know that, we can tell you all of these numbers and give you some insight. So our next webinar that we'll be doing next month is on average rate. So we're going to dive a bit deeper into average rate to give you some more depth around some of those strategies, maybe and clarify that a little bit more, sort of showing you the impact of different departmental focus has on how you drive improvement in that profitability. So thanks again. My name's Matt Sleater, the lawyer's accountant. Thanks again for your time today, and we'll talk to you soon.